I'm not the deep, 30, 40-year aviation expert, so I've had to learn these things. And sometimes coming in with a fresh pair of eyes is a good way to look at things.
Spending decisions by Americans, as Grant alluded to, for even what his business is doing, people paring back what they're doing. You've got the heightened consumer uncertainty.
Well, I think what we're doing is underwhelming and quite short-sighted.
It offered him terms and conditions that would be similar to an employee. For example, sick leave and annual holidays.
Welcome to the Weekly Wrap, where we go over MBR's top video stories from the past week. First, Air New Zealand has unveiled its newly retrofitted 7879 Dreamliner, featuring a significantly upgraded cabin layout aimed at attracting premium leisure travellers, with the first revamped aircraft set to begin service on May 19. Will Mace with this.
To be able to have an announcement like this and actually have the product now back in New Zealand and about to fly is a big deal for our customers and a big deal for the 12,500 Air New Zealanders. So I'm excited for everyone. It's actually been 180 days to get this plane from go to woe. We thought maybe we get it done in about 60 or 70, so it's taken about 3 times as long, and it is complex. Lots of regulatory approvals that have to be gained, and there's really only a couple of places that do that. Europe and the United States. The FAA out of the US has been difficult, but we've got that. So this particular plane gets up and running in exactly 2 weeks from today. So Monday, the 19th of May, I'll actually be on it. Not only will it be this plane, but the crew will be in the latest uniforms, and we'll be shooting off to Brisbane and doing what we call a double banger. So we fly there, we're on the ground for about an hour, passengers off, passengers on, catering on, and we fly back again, and then it sits on the ground for a couple of hours before it shoots off to San Francisco. As industries tend to do, they sort of go from vertical integration to outsourcing, and then they bring it back again. In this particular case, we have had to rely pretty heavily on Boeing, and that required a candid conversation, frankly, that I had with Boeing, where I sat down and said, you guys are going to struggle to get these retrofits going. You're running behind on new aircraft. The war in Ukraine and Russia has taken sort of circa 2,000 of their engineers out of their system. So what we need to do is come up with a different way of working, a more agile approach to it. And they listened. And I said to them, if there's an airline around the world that you should try this on, it's actually Air New Zealand, and it's because we're agile. We're small, we're nimble, we can do things quickly, and they agreed with that. So what you're seeing here is the result of us sitting down and saying to Boeing, quite candidly, we can help solve a problem for you, because if you can work out how to do this with us, you can then work out how to retrofit United, and, Delta and British Airways and all the others. And that's what we've done. And I'm thrilled for the team that we've been able to pull this off. I'm thrilled for our customers, because they've been waiting, the best part of 25 years for new product on a plane. And give us another less than 2 years and we'll actually have all the planes retrofitted. In about 12 months, we'll get the first of the new ones, and Air New Zealand really then is back on the trajectory of newness and innovation that I want. We're still fundamentally on our wide-bodied fleet, and they're the Dreamliners and the 777s, so what we call the two-aisle planes. We're fundamentally a premium leisure market, and doesn't that make sense? Tourism is so important to the country. Just international tourism, I think, generates the best part of about $13 billion worth of wealth to the country. So it's number 2, just behind dairy, etc. So premium leisure, and we try and keep it reasonably simple. We're not big enough to be running a first class. So it's business class, it's premium economy and economy. But within those sections, there's some unique products, and I'd imagine Baden's taken you through some of those already, so I won't repeat them. That's a different feel to what you get on the single aisle, the narrow body jet or the turboprops. And that product is really about appealing to all customers. So when you get on a Airbus A321 or a 320, we don't distinguish between the classes. It's just one style of seating, and the same obviously with the turboprops. And we think that's appropriate based on New Zealand, its scale and our customer base. So we're a bit unique. We operate a brand that has to stretch across a couple of customer groups, but we've looked at that several times and we've said, we think that's right. I'm not the deep 30, 40 year aviation expert, so I've had to learn these things, and sometimes coming in with a fresh pair of eyes is a good way to look at things. But yes, there's no doubt our product's 25 years old. Incredible sleep, I might add, on the current bed that we have, but you need someone to help make it up, and there's not a lot of privacy, and you are sitting at sort of a 45-degree angle to the front of the plane. It's hard to see outside the windows, and it's got the smallest sort of entertainment screen of literally any airline that I fly on. So those things we can address. The herringbone one is an interesting one. I guess as I've travelled, what I've noticed is having your head away from the aisle when you sleep actually creates a better sleep. Now the issue when you go front to back is that one of the seats is near the window and the other seat is near the aisle. So you've got some preferential seats to non-preferential seats. And I notice that when I fly other airlines, that absolutely the preferred seat is the one that's near the window. In our business class area, every seat is the same. And what we've been able to do is by carefully adjusting and manipulating how the thing is laid out, we've actually got it so it's actually pivoting around much closer towards the front. So I'm very happy with where we've ended up. I hope what happens, to be completely frank with you, is that we end up selling seats earlier, in which case actually our revenue will improve because this will become a more desired plane to be on. And having travelled most of the others, I would say to you that what we're starting to do now puts us back up the front, which I'm excited about. So naturally what should happen in the process is we should actually see improvement in revenue.
Dollars and Cents is back. This week our panel takes a look at how Donald Trump's tariff policies have triggered global economic uncertainty, prompting businesses to brace for shifting trade dynamics and the ripple effects on growth. To debate and discuss, ASB Chief Economist Nick Tuffley, Moody's Analytics Associate Economist Shannon Nicol, and THL Chief Executive Grant Webster. First to you, Grant. How do you and THL manage Trump and the tariff situation?
Without using cliches, with great uncertainty. So, look, for us, we're just dealing with what's happening on a week by week basis, creating a couple of different scenarios each time something changes, because you could create so many, and just running with those scenarios and adjusting our business accordingly. But it's a very challenging time in North America, no question.
What's the here and now for your business?
So the here and now for us is twofold. One is that from a vehicle perspective, we've got an impact from the retaliatory tariffs of Canada are put in place because we buy all our motorhomes and RVs in the US and move them to Canada. So that's impact number one. And at the moment, we managed to get a decent amount of fleet up pre-tariff, so we're sort of okay. But that's a pretty high impost there. It's around 22% effectively when you run through everything. The second thing is that tourist demand into the US. So for us, that Germanic Europe, particularly demand into the US is key for the US rental market, and that's down dramatically. So last few weeks, 40 to 50%.
Is that a sustainable business model for you to operate long term, taking it week by week, month by month?
So couple of key things. We think that ultimately what we've seen over different times, the customers have a reaction to something in time, the market adjusts and moves. So airlines in particular will adjust their pricing. All of a sudden it will come to a price point and an incentive. People go, oh, okay, well, maybe it's not that bad and I will travel to the US. So we've got a firm belief that this is a point in time situation. So we'll manage to that. At the time in between, though, yes, you do retrench somewhat. So the capital expenditure for us in the US is definitely going to be less in the next 12 months than it would have been had these tariffs and this level of uncertainty not been created.
Nick, to you, it looks as though the US economy has contracted or is heading towards a recession?
Well, we certainly got that news for the first quarter, like a really marginal contraction, in an annualised terms. But yes, more of the disruption likely to pile up in the second quarter, particularly with the risk of imports being sort of closed down, people potentially spending less through there being less availability of some goods, and also just the added uncertainty too. But you get swings and roundabouts coming through. One of the things with imports is that it's something that you subtract off everything else, so you're not double counting, and we're likely to have that sort of plunge in imports as well. So it's really going to matter what's also happening to the sort of stock levels in the US and consumption. But if you're looking at spending decisions by Americans, as Grant alluded to, for even what his business is doing, people paring back what they're doing. You've got the heightened consumer uncertainty that's already hitting. It's consumer confidence has absolutely plummeted. So that caution over spending, let alone before you get into availability of goods for consumers to buy, and decisions by businesses on manufacturing or even their ability to keep manufacturing, because you're already seeing some disruption, particularly in the auto industry, coming through. So for the year, probably not an overall recession for the US, but it's a heightened risk. But the first half is looking very risky at there being like a recession or contraction over that first half of the year.
And Shannon, we're only partway through this 90-day pause on the tariffs. How are you monitoring that situation?
Well, as has been alluded to previously, it's all about managing risk and trying to navigate through that. Our expectations for Australia and New Zealand in particular, as well as many other countries, is that the Trump world we live in broadly, and the impact of tariffs is that they're diminishing growth prospects rather than derailing growth prospects. So I think that, broadly in Australia, you've seen the economy go from strength to strength last year. That'll continue this year, but it's going to be it's going to be more lackluster than we hadn't anticipated. In New Zealand as well, that budding economic recovery that we've seen begin late last year, that's going to continue, but the impact of a weaker global demand for Kiwi goods and, also, more uncertainty surrounding what is proper investment decisions for firms is going to keep investment and export growth a lot more lackluster than we had anticipated, even 2 months ago. That's broadly our expectations.
And Nick, what does that mean for decisions by the Reserve Bank here in New Zealand?
What we're looking at from New Zealand context is potentially, and this is like a very broad brush, we could see our GDP growth slower by, say, 0.5%. Look, a lot of dust to settle around that. We're assuming that the tariffs that we are seeing globally settle for the main, for most people, 10%, even countries like Europe probably around 15%, but assuming that there'll be at least a halving of the tariffs on China, so somewhere around about 0.5% off our growth. When we're looking at what does it mean for inflation, which is what matters for the Reserve Bank, when we're looking at the medium-term pressures, there may be a bit of noise in the short term, but that sort of slightly slower growth means sort of less capacity pressures, less inflation pressure. So look, we recently shifted our view to the Reserve Bank is likely to cut interest rates to around 2.75% instead of 3.25%. A lot of water to go under the bridge, but the risks clearly tilting towards the Reserve Bank will have more leeway to cut interest rates to stop inflation from starting to fall into the bottom half of the target band rather than hovering at or above.
Do you think Trump will negotiate good deals with countries with tariffs?
Look, I think the Well, for him, I think the view was going into this, look, it's going to be pretty easy to negotiate some pretty widespread deals. It's going to be a range, I think. We're going to have countries like Japan where they are more likely to negotiate some sort of deals to come through, because there's a lot of other things that Japan will be looking at in terms of security arrangements and the like, which will come into that. Countries like India, probably it's going to be pretty hard to start justifying why you have a 100% tariff on this, that, or the other thing as well. Europe, they'll, I think, negotiate relatively hard, and they look reasonably prepared to put in place retaliatory measures that will impact on the US as well. Where I think the US is running into challenges in getting a so-called good deal is with China, because it looks like their strategy at the moment is that we'll just take it on the chin and we'll just punch back just as hard as we are getting, with a view that yes, we will take some pain, but you, US, you're going to be wearing a lot more, and you won't be able to tolerate it for as long. That's where I think the uncertainty for global growth and where the potential miscalculation for the US lies.
What about in Australia, Shannon?
Yeah, I think that broadly the uncertainty around tariff and global trade policy is sort of it's weighing on. In the trajectory for inflation is sort of a more moderate downside risk. In broad terms, that's allowed us to push forward our expectations for a rate cut until May, and that'll round out to about 4 cuts this year. So generally, as you know, exporters globally look to maybe potentially target Australia as they discount goods to try and re-establish themselves in a sort of comparable market. That's allowed, I think, the RBA to act perhaps more sooner, but maybe not with more severity than it otherwise would have.
Let's get back to you, Grant. In terms of your business decisions this year, are you putting some things on the back burner or on ice?
From a North American perspective, yes. So in the USA, I mean, a number of the decisions for us, the high season, travel season is coming right now, right? It's May, June, July. So a number of those decisions are made. But we do make capital decisions this year that flow through into calendar year 26. And the reality is, yeah, we're pulling back. So we'll see our capital expenditure there in the US could easily normally be 50, 60, 70 million gross capex and new fleet expenditure, and you're going to see that drop substantially, and we're a tiny company in the US context. So that contraction that Nick and Shannon are talking about, I mean, we're a real life example of it, and it reflects the uncertainty. So we expect that others in the industry are doing the same thing.
So what's the domino effect? You talked about the US, but what about your other markets?
Yeah, so actually, the domino falls to a more positive outlook for the other markets, really, from a tourism perspective. Somebody said, albeit maybe inappropriately, somebody said that Trump's been the best ambassador for Australian New Zealand tourism that there's ever been. There's each of the major countries around the world have a big sort of showcase event once a year for all the trade buyers around the world. ATE, the Australian Tourism Exchange, is on this week. And being there this week, it was very positive. I think Australian tourism is actually in the most positive position that it's been for decades. The currency's helping that. It's a cheap destination today. But those customers that out of Europe that were looking at going to the US are looking at Australia and New Zealand. They're a viable, good, safe, friendly option in comparison.
And Nick, back to you. It looks as though Europe is strengthening its ties in terms of trading relationship between European countries.
Yes, and that's one of the ironies and hopefully a positive outcome over what we see is that various countries do start to look at how they can increase their trade with each other. And you can throw into that China as well. It is going to be looking quite desperately for other markets, particularly just for the short term, but also everybody for the longer term starting to have a good hard look at the US and going, well, how reliable are you going to be as a long-term trading partner and wanting to de-risk themselves? So we may well see a lot more collaboration coming together of countries. It may be slightly easier for us to get a free trade agreement with India, for example, if you've got Donald Trump driving a Mack truck through their tariffs and making it harder for them to justify having high tariffs on some of our products as well. So we'll see, but there's also tensions as well, because there will be fears of, say, particularly Chinese goods being dumped, quote unquote, in markets, and potential for some countries to put up barriers there. But yes, I think we'll see a lot more cooperation.
So who's going to come out a winner at the end of this?
I think some people have already quoted that it's pretty hard to see a winner out of a trade war. What I suspect we will see is, in terms of economic growth impacts, Canada is going to be hit the hardest in terms of what happens to its GDP. It is probably going to be in a mild recession for a lot of this year. US, we'd expect its growth is probably going to be sort of ballpark pretty much halved this year. It's not exactly going to be winning in the short term. China will probably keep itself from falling back too much, but only by a huge amount of fiscal stimulus. Long term, will the US be a winner? Is everybody going to pull their manufacturing back and put it in the US, create jobs and make America great again, as the strapline says? Probably not. I do think we'll end up seeing this as being a period of lost growth. And I think between China and the US, the US may be finding that it's not really winning that much. China hoping perhaps with this confrontation that it will increase its influence with the rest of the world. So that's not exactly a win. It's a Pyrrhic victory, I think, on both sides.
Shannon, what lessons do you think the US may learn from all this?
I mean, there's a lot to take from it. I think that the US will ultimately have to learn and reckon with the fact that tariff barriers are a structural barrier to productivity and gains in their own economy. I think that it's going to, hit their economy quite a fair bit more than maybe they had anticipated. The Trump administration certainly probably didn't fully consider the impacts of what they had outlined prior. I think that they're, in a sense, becoming more, they're learning a bit more about how they can navigate and place themselves on the international stage from this. I don't know if it's working in their favour to be as aggressive with trade policy as they might have thought.
And Grant, businessman to businessman, if you had the chance to sit down with Donald Trump, what would you say to him?
That's a really, really great question. I would just say, take a chill pill, please.
Simple as that?
I think it's just got to calm down, right? We're just got to calm things down. We all know that the level of volatility, the level of uncertainty is what is creating that consumer confidence withdrawal and everything around it. So if we can just calm things down, if we can just get some certainty, then we'll move forward. I do find it really interesting that the manufacturers that we deal with, that the colleagues that we deal with in the US more broadly, do fundamentally still seem to have a very strong view that this is very short term and that everything's going to be okay.
But there are more years to come with Donald Trump, so how do you navigate that?
Well, look, I think ultimately you've got to play what's in front of you. You've got to be, we're going to be somewhat shocked from this event, and we're going to have some kind of reticence over the next few years. But ultimately, as I said around travelling tourists, right, ultimately the US is still the largest economy. It's still, from a tourist perspective, a very attractive destination, and it's still got a lot going for it. So I think the machine of the USA will keep going and provide some confidence to people over time.
And Nick, what can the Fed do in all this?
The challenge for the Fed is it's got the inflation aspect to look at, the employment aspect to look at, and they're going to be in a bit of conflict with that this year. We are going to see a short-term spike in inflation, and inflation expectations amongst consumers are already skyrocketing, mainly amongst Democrat-aligned consumers, though, so Republican supporters may have a little bit of a rude shock coming down the track. So that's a bit of a warning sign for the Fed that if inflation picks up, it could get back into that sort of ingrained inflation process where if you believe inflation is going to be high, your behaviour changes and ingrains inflation. So they'll be juggling that. a lot of the impacts are likely to be sort of 12-month type impacts in terms of prices lift and then hopefully stabilise, and we may even see them fall back down the track. So the Fed will need to be balancing that against what's happening to employment, also what's happening to your longer term capacity related inflation pressures, and whether that starts to come through and be more dominant when you're getting into sort of 2026. So look, we think the Fed will still cut interest rates, but it's going to be waiting and seeing until around July. So a couple of more months to get a little bit more clarity. And look, we don't even know until July 8th is the end of the 90-day pause. We don't even know what deals will be coming through at that point. So a lot of uncertainty. Won't stop the Fed over the longer term from cutting rates in our view, but they're going to be very cautious over the short term.
And coming up on the NBR podcast, no one predicted a Labor landslide, yet Australian Prime Minister Anthony Albanese delivered an increased majority against Peter Dutton and the Liberals. What was behind the result? Was there a pushback against the political influence of Donald Trump? And are the independent candidates a threat to Liberal Party survival?
It's a drubbing.
We didn't do well enough during this campaign. That much is obvious tonight.
So, what was behind Labor's dramatic turnaround?
I think the Australian people have got the name.
What amazes me is that at the beginning of the year, incumbency was the curse. There was a huge reaction against incumbency in government because of the cost of living, because of inflation. 4 months later, incumbency is a virtue.
What we know is that the independents have actually done very well.
If they are unable to learn the lessons of not just this election but the one before, then quite possibly we will see them disappear.
The party's kind of changed, and so I'm going, well, let's get off this beauty pageant cheering for the prettiest girl in the room sort of thing, and let's talk about the issues, and who cares who picks them up, but whoever's going to tax these corporate bludgers, let's go for that.
And that episode of the NBR podcast will be available free wherever you get your podcasts on Tuesday, or subscribe to listen right now on nbr.co.nz. Back home in this week's Shoeshine, despite years of shifting targets and reforms, New Zealand's R&D investment still lags behind global benchmarks, with critics warning that without a serious funding boost, the country risks falling further behind in innovation and productivity. Here's Fiona Rotherham.
So why did Reti scrap the target?
So this target was set in 2018 by the Labour, New Zealand First and Greens coalition, and it was to try and get R&D spend to 2% of GDP. That's a reasonable target. At the time it was only 1.275, and so it was a bit of a stretch. It sort of set 10 years for achieving that, but it never got there. Successive governments have simply shifted out the target, and so Reti's now scrapped it. But it doesn't do away with the underlying problem. We're not spending enough.
Right.
So I put it to him, if we don't have a target, we won't achieve anything. So the latest figures show the figure's now gone to 1.54, so it's a big improvement. But it's still way under the OECD average, which is 2.7, so we're underspending relative to other nations. Reti says he's actually a fan of targets, and they're not off the table, but he wants to get advice from the Science System Advisory Group, which is looking at the science sector reforms, their second report. He wants to get advice from them before looking at what he might replace that former target with.
Right, okay. Do you believe that he is a fan?
Well, it remains to be seen, doesn't it? I mean, it's sort of sweeping the problem under the carpet almost, isn't it? And he's already had the advice. The first SAG report was really clear about the case for more investment from government. It said basically underinvestment in R&D has been crippling for the New Zealand economy, and it's argued, other Western nations have been spending more despite economic difficulties, but New Zealand hasn't been. In particular, the government and university spend is down. Business R&D's gone up. They've sort of lifted their game, which is great, but we need it to be matched by what the government and universities and Crown Research Institutes, etc., are doing, and it's just not happening.
Right, so we've been underspending, and so what does Reti say about that underspend?
Look, he acknowledges that that's the case.
Yep.
He says he's aware of it, but he reckons these big science sector reforms are doing, the consolidation of the Crown Research Institutes, the shutting of Callaghan Innovation, all of that, he says, is about getting more bang for the buck on the $1.2 billion a year that they do spend on the sector.
Yep.
So saying, let's get the system right, let's make sure we're actually utilising the investment we are making, and then we put the case for extra funding. Right. But I think it's just simply kicking the problem to touch in some respects.
Okay. So is the R&D tax incentive actually going, or is it staying?
So it's a key driver of that business spend on R&D, and the government's just done a statutory review of the scheme, which was introduced by Labor. It replaced the growth grants that Callaghan Innovation used to do. And that report's sitting on the minister's desk as well. He won't say what's in it, but he did say it was encouraging. So ACT has sort of called for it to be scrapped, and some ministers have been sceptical about the need for it. Business New Zealand got a bit upset about this and put out a paper late last year as a sort of stake in the ground, as it were, saying that arguing for continued support. And they put in a lot of numbers there around what the return has been and the value of it in lifting bird. It's really helped larger companies spend more.
Right.
So you've got the likes of Xero, Fisher and Paykel Healthcare are the biggest recipients of this money. Small companies not so much, because unless you're earning or spending around $1 million a year in R&D, it's not really worth the administration costs. It costs quite a bit. It's quite difficult to actually get the incentive.
Yep.
But what's the alternative? Not do anything. They also introduced some grants which are handing out around sort of $70 million a year. It's just under $1 billion a year goes out in this tax incentive. So I think they will continue it, but it remains to be seen when the minister releases that report.
The government is all about the commercialisation of ideas and research and things like that. So should more money be going towards the commercialisation end?
I mean, the argument is yes. There should be more money all round, and definitely more money in that ecosystem. You need that research to come out of the public institutions. You need it then to be into startup system and into products that get sold offshore. That's the whole sort of pathway.
The whole point, right, yeah.
But only 1% or less than 1% of that budget of that $1.2 billion a year goes into that commercialisation pathway. And there is an argument for upping that because it's been successful. That, studies have shown the money we've spent has been worthwhile. But Reddy, of course, is not promising any extra money. He's simply saying that this whole science sector reform is a pivot towards commercialisation and should deliver a better outcome because of that.
So, taking an overall view, how would you sum it up?
Well, I think what we're doing is underwhelming and quite short-sighted. And I think the government seems hell-bent on getting this budget back into surplus and cost-cutting, when really, it's taken the wrong view of what R&D spend is. It's actually an investment that delivers a good return rather than a cost.
A recent employment court ruling underscores the importance of clearly documenting changes in working relationships as disputes over contractor versus employee status continue to spark legal and political debate in New Zealand. Buddle Finlay Special Counsel Sean Brooks speaks with Fiona Rotherham.
So tell us about the details of this case, Sean.
This case really follows on from the Uber case from last year. And it's another case where the person being engaged says that they're an employee, or they're in fact an employee, where the contractual arrangements indicated more of an independent contractor arrangement with a separate business. It's an interesting case because the relationship did change over time. Undoubtedly, to start with, it was a contractor arrangement, but as things progressed and the company engaging the contractor wanted more and more, the relationship changed more to the nature of an employment agreement or an employment relationship.
So, Sean, it was a case involving a biotech company, wasn't it? And the guy involved was as you say, an independent contractor, but then it changed to a CFO. Is that correct?
Yes, it's correct. So initially he was engaged, or his company was engaged, to provide virtual CFO capability, and that was approximately 5 hours a week. As the relationship progressed, or as time went on, the company decided it actually needed more capacity in that role. So it engaged him to work 50 hours a week. As you can imagine, there's not a lot of time outside of that to then work other engagements as well. So previously, when he was only working 5 hours a week, he was also providing similar services to other companies. However, when it went to 50 hours, he was predominantly working for that company and providing, again, the CFO services, And there are a number of things that changed, but one of the key things that didn't change was his invoicing. So he would still each month invoice, and he was then doing his own tax. So the company said, well, he got a benefit from that, a tax advantage from remaining a contractor. He was obviously sophisticated financially as he was in a CFO role, and he held himself out to do that. So this wasn't someone that was in a vulnerable position that didn't know about the advantages and disadvantages of employment and or versus contractor.
It
So
seems
they
pretty
said,
cut and dried. What was the dispute actually over?
well, there are a number of meetings, and it appeared that the meetings did discuss an employment relationship, and there were also changes made within the company's system, so it recorded him as an employee, and it really it offered him terms and conditions that would be similar to an employee. For example, sick leave and annual holidays, which again are key indicators that someone's an employee rather than a contractor.
Both parties seem to have different recollections of what went on and what was discussed. What's the lessons for that for other employers, do you think?
Really putting things down in writing is key, and having an employment agreement or being clear that the contracting agreement remains in place, because that had expired and there was no other written documentation in place. It is a requirement to have an employment agreement if there is an employment relationship. And equally, if there's not, then there should have been something in writing that extended or continued on the contractor's agreement.
Was performance an issue in this as well that sort of muddied the waters?
Towards the end, yes, definitely. And that's why the the relationship came to an end. And obviously, an employer and employee relationship, there's a bigger bundle of rights for that employee. The company can't just unilaterally terminate that relationship by giving notice, which is what it did. So by getting a declaration that he was an employee, those other rights were then engaged, and he will have a claim against the company.
One of the issues, as I understand it, also was that the CFO would get a share entitlement from the company, because obviously the remuneration is less in a small company than it would be in a bigger one. So what did the court decide over that issue?
Yeah, absolutely. It was something that was in dispute about what, if any, employee share entitlement there was. Undoubtedly, there had been some discussion, and the court thought that that indicated there was that shift towards an employee-employer relationship. It also looked at the remuneration. So under the contractor's agreement, the rate was $300 per hour. And that was on the basis that it was about 5 hours per week that was required. But when the relationship changed so that the person was providing 50 hours per week, the rate changed to $95 an hour, so significantly less. And you're right that this share offering was dangled in front of the person's nose and an incentive for them to take that significant drop in hourly rate, but nothing was ever agreed or in writing before the termination.
You mentioned the Uber ruling. What are the key factors that determine whether someone is an employee or a contractor?
It's being done in 2 steps now. So first of all, the court will look at the degree of obligations and rights, and that's generally in whatever written and oral agreement that's in place. And then they'll compare that with the common law tests, and there's sort of 3 common law tests, which are the control test, the integration test, and the fundamental test. And each of those take into account different aspects of the actual relationship in practice to determine whether the reality was the person was an employee or whether they were a contractor. Relationships can change over time, and employers should reflect on what they have in place as time goes on. So if they have a contractor who maybe has been in place for a year or a couple of years, it would pay to go back and have a look at those agreements and check that they still reflect reality.
I see the new minister, though, is introducing a new gateway test. How's that going to change things once it's passed?
It'll be interesting to see how that plays out. I haven't read the bill yet, so I would need to have a look at that and compare it more closely with the common law tests. Generally, there's a reluctance by the courts to find that none of the rights in the Employment Relations Act or the Minimum Wages Act or the Holidays Act apply, and the person is in fact a contractor rather than an employee. So there is that inherent imbalance between an individual and a company, and what the employment protections aim to do is to close that gap and provide some protections for the individual. So the courts will look for reasons why the relationship is in fact an employee relationship, and they'll be reluctant to say, well, none of these protections apply to this person.
Do you think the gateway test is aimed at changing that?
Potentially. It will depend on how that bill shapes up.
Thanks again for joining us. Our news team is back from 5 a.m. tomorrow with the latest business news you can use on mbr.co.nz. See you next week.